Welcome to Automating Wisdom. Today, we are cracking open one of the most influential books in the history of technical analysis. Secrets for Profiting in Bull and Bear Markets by Stan Weinstein. The core philosophy of this book can be summarized in 3 sentences. First, the market is the ultimate weighing mechanism, where price and volume tell the real story long before the news hits. Second, consistent profit is not a matter of luck but of strict adherence to a mechanical system that eliminates emotion. Third, the life cycle of every stock moves through 4 distinct stages, and your success depends entirely on knowing which stage you are in. The specific pain point Stan Weinstein solves is the fundamentalist trap. Most investors are taught to look at earnings, products, and management, but by the time a great earnings report is released, the insiders have already bought, and the stock is often near its top. Stan argues that fundamental information is already priced into the tape. The solution? A methodology focused on the 30-week moving average. Weinstein urges investors to never buy a stock trading below a declining 30-week moving average and to never hold a stock in a stage 4 decline. This one rule alone can save you from 90% of the catastrophic losses that plague amateur traders. Let's dive into the core modules of Weinstein's strategy. To profit, you must be a stage analyzer. Stage 1 is the basing area. This is when a stock stops falling and starts moving sideways. The 30-week moving average flattens out. This is equilibrium. Buyers and sellers are matched. It's the time to watch, but not to buy. Capital tied up here is dead money. Stage 2 is the advancing phase. The buy zone. The stock breaks out above resistance on heavy volume, and the 30-week moving average starts turning up. This is where the big money is made. It's the only time you should be heavily invested. Stage 3 is the top area. The momentum stalls. The 30-week moving average flattens again, and the stock churns on heavy volume. This is the distribution phase. Smart money is leaving, and the public is entering. Stage 4 is the declining phase. The danger zone. The stock breaks below support and the moving average turns down. Gravity has taken over. There is no such thing as cheap in stage 4. Weinstein teaches us to filter from the top down. Check the forest. Is the overall market trend positive? Check the group. Is the industry strong? A leader in a weak group will struggle. Check the stock. Identify the triple confirmation pattern. The triple confirmation consists of 3 signals. First, volume. It must explode on the breakout, at least double the average. Second, relative strength. The stock must be outperforming the market. Third, price action. Volatility in the base indicates explosive potential. Selling is purely mechanical. Use protective sell stops. Never hold a stock without a plan for when to get out. Place your stop initially below the prior support level. As the stock moves up in stage 2, trail the stop under each successive correction low. Never, ever hold a stock that breaks its 30-week moving average on the downside. Emotions have no place in the exit. How do we automate this wisdom? The quantifiable concept is the stage classifier. We can write a script that calculates the 30-week moving average and identifies crossovers. The challenge is this: can we create a scanner that filters for stocks where price is above the 30-week moving average? The slope is upward, and volume is exploding? This algorithm effectively automates Stan's eyes. By running this scan, we remove the hope and replace it with data. Is Stan's method perfect? We must have a reality check. First, the whipsaw. In a choppy market, the moving average can generate false signals. Second, the time lag. Because it uses a 30-week average, the system is slow. You won't buy at the absolute bottom or sell at the absolute top. Third, the volume fakeout. High volume can sometimes indicate climax selling rather than a breakout. Now, I want to hear from you. First, if you could only use one technical indicator for the rest of your life, would the 30-week moving average be enough? Second, have you ever held a great fundamental stock all the way down into stage 4? Third, in today's high-frequency world, is a 30-week trend still the master trend? Comment below. The most insightful comment will be pinned. Remember, the tape tells all, but only if you know how to read it.